Jess said, the topic today is how Sharesight reports your investment performance. And I think this is a very important topic, and it's actually the main reason why we created Sharesight in the first place. So a very common response that I hear when explaining Sharesight to someone new and, try and tell them what it's all about is that they'll say, well, that sounds great, but I already get this from my broker, or my broker already does this for me. And so in our experience, brokers actually do a pretty terrible job of providing insight into your investment performance. So today I'm going to focus on how Sharesight reports your investment performance and why. And we'll run through some of the reporting options that are available. Before I start, just like to take a step back and look at the overarching goal of performance reporting, which is essentially to provide a means to assess the relative performance of your investment, both within your portfolio and also, against other investment opportunities that might be out there. So let's start with a really simple example of an investment in company A and an investment in company B. So we can see here that company A has made a $600 gain, company B has made a $200 gain. And of course, knowing the dollar gain is a very important piece of information, and Sharesight will always show you what the dollar gain is. But the question arises, which one is the better performer? So I guess the first piece of information we need to know is something about the purchase value or the purchase cost. So in this example, let's say for both investments, the purchase cost was $1,000. And you can see that I've put here the current value, $1,600 for company A and $1,200 for company B. So we can kind of derive that the purchase cost was $1,000. So the first thing that we can do is take the gain and divide it by the purchase cost and get a percentage return. This is basically what most online brokers do to report performance. So, it would be reasonable to assume, I guess, in this case, that company A is the better performer. This could be horribly misleading, however, because in order to assess the relative performance of each investment, we actually need to look at the rate of return, which means the return with respect to the time that it's been invested. So if I told you that investment A had been held for 3 years and investment B had only been held for 1 year, that might change the way you think about which one is the better performer. So first topic I want to cover is annualisation. So annualisation is the process by which we calculate a rate of return. So Sharesight provides an annual return figure wherever the investment period is greater than a year. There are actually a couple of different annualisation methods available in Sharesight, so I'll briefly talk about each one. So if we take our example, and I've plugged in the years held here, the first thing that we can do is simply divide our total percentage by the number of years held, and in this case we get a figure of 20% for each investment, and we could then use that to, I guess, conclude, the performance of these two companies is, the same, and that kind of makes sense and seems reasonable. A slightly more sophisticated approach would be to calculate a compound return, or what's called a compound annual growth rate, and this makes the assumption that investments increase in value exponentially, i.e. year-on-year growth. And I guess maybe just to clarify what we mean there, if we take company A, we'd say that it started at $1,000. So we've calculated a compound return of 17% now for company A. Company B is 20% because it's just been held for a year. So looking at what's happened with company A would model it out so that started at $1,000. It grew by 17%, and that's $1,170. We then grow that figure again by 17%. That's $1,300 and something, and then we grow that again by 17%. We get to $1,600. And if we did it this way, we'd actually conclude that company B was the better performer. So I think it's important to note that these are just assumptions that we need to make in order to compare investments of different time periods. So basically just an assumption we're making around how these investments grow. You can use whichever method you prefer. The most important thing, I think, is just to understand the differences between these assumptions. And of course, if you're comparing return figures quoted in Sharesight with figures quoted outside of Sharesight, it's obviously really important to make sure that you're comparing like for like. So you can change the setting in Sharesight. It's on the settings tab under basic details, and there's a little drop down for performance calculation methods. So feel free to change that to whatever you prefer. Okay, so let's jump into another important aspect of performance reporting, which is basically to consider the complete picture. Obviously, it's important to consider all of your trades and all of your transactions. And as a broker agnostic platform, Sharesight's got a number of tools available to help you to import data from a variety of sources, regardless of which broker or brokers you use. And I'm sure we'll have a separate webinar on that topic. But I guess, as I'm sure all of you that have used Sharesight already have noticed, Sharesight breaks down your returns into three separate components: capital gain, dividends, and currency gain. So let's briefly look at each one and why they're important. All right, so capital gain. This is the gain that you have made on any changes in the share price, and we convert this into your local currency. Pretty straightforward. Often with portfolio tools, this is really the only component of the return that they will report. It's usually the major component of a portfolio return, of course. One thing to note with the capital gain figure in Sharesight is that it does factor in brokerage. So any brokerage fees that you pay on your buy and sell transactions is subtracted from the capital gain to give a more accurate figure. Next up is dividends. Dividends can often be a very significant part of your portfolio return and are often overlooked. I think one reason for this is simply because the data is not available. So if you're using an online broker, they obviously know about the trades that you place through that broker. They typically don't have data about the dividends that you've received because those dividends are paid to you from the company via the registry. So unless you're using a custodial system or a managed kind of platform of some sort, your online broker doesn't know about your dividends. So often that aspect of performance is kind of skipped completely. Sharesight solves this problem, of course, by automatically populating and recording dividends, to the best of our ability. You can also edit that data and manually record your own dividends. So it's important, of course, to get your dividend entered correctly for tax purposes, but it also allows you to get a more accurate picture of your portfolio performance. And I think, we often find that when Sharesight customers get their portfolios set up into Sharesight, they're kind of surprised at just how significant the dividend component is. I think one reason for that is that often a way to kind of assess the dividend gain for a company is to kind of look at the dividend yield that might be published, and that's looking at basically the dividend payment in cents per share divided by the current share price. But when we're calculating dividend gain in relation to your portfolio, we're actually looking at the dividend payment in relation to the amount that you paid for the shares originally. And that can, when you look at it that way, dividends can become a significant component of the portfolio return. A couple of other things worth noting about dividends. Firstly, the gross dividend amount is used to calculate the dividend gain. And that is to say that this figure includes any tax credits, so franking credits in Australia, imputation credits as they're called in New Zealand, And so this appropriately recognises the fact that a dividend with tax credits attached holds more value than one without, even although the cash payments may be the same. So Sharesight performance figures are gross of tax, and this is of course consistent with the way that virtually all investment returns are quoted. A second point worth noting is that we include dividends based on the ex-date. So the ex-date is used to determine when a dividend is included in your portfolio return. Essentially, if you hold shares on or before the ex-date, you are guaranteed to receive that dividend payment. The ex-date is when the dividend is calculated. And the main reason that we do this is that you'd usually see a dip in the share price following the ex-date of the dividend. And the share price usually dips by roughly the same amount as the cent per share dividend payment. So by doing it this way, we just go to prevent any erroneous performance fluctuations that would otherwise occur. For example, if we included dividends based on their paid date. All right. And so the final component is currency gain. When investing in overseas shares, currency gains or losses can be very important. And again, this is another often overlooked aspect of portfolio returns. And just to illustrate this point, this is a portfolio containing some US tech stocks. It's in a New Zealand portfolio, so this is looking at returns from a New Zealand perspective. I've adjusted the date range here, so we're reporting from the 1st of February through to the end of March. That's basically capturing all of the market turmoil around the coronavirus pandemic. So you can kind of see in this example, if we were just evaluating these stocks based on what's happening to the share price, it's pretty dire in this case. It's a nearly 10% loss in a 2-month period. But actually, during this time, the currency has been really volatile and really significant as well. And I guess you could easily be a lot more depressed about the situation if you didn't have oversight of what the currency is doing, which actually goes to offset a large component of the capital loss in this case. Another really important aspect, I guess, of performance reporting is just being able to customize the time period. So Sharesight allows you to report performance over any time period you choose. In this case, I've honed in specifically to a period of disruption in the market. Another use case might be to actually look at how your portfolio is performing up until this point. And it's obviously important to be able to put current volatility and what's kind of happening in the short term into context by looking at your longer overall portfolio performance. And actually, not so long ago, I was looking at a report of it was like the best performing Australian ETFs. I think it was like the 2019 calendar year or something like that. And I cross-checked this list in Sharesight, and sure enough, it was fairly accurate. But what struck me was that just by extending the date range out by a couple of months, so like reporting 14 months instead of 12, or just shifting the time period forward or back a couple of months, actually, substantially changed the order of what the best performing ETF would be. So, I guess the takeaway here is that, if you're just relying on a static quarterly or annual report, you're likely missing out on some important insight. Okay, the next thing that I wanted to talk about was the open and closed position setting. So this is another really important report setting. We know that most of the time when people log into Sharesight, it's just for a quick check to keep tabs on how your current shares are performing. And obviously your currently held shares are the ones that you want to monitor, and these are the ones that are exposed to the market. So by setting this filter to open positions, we're basically just reporting on the performance of the shares that you currently own, and it's of the shares that you own as at the report end date. And so I guess, for example, if I own some Apple shares, I purchased a large quantity of them, then I sold them, and then maybe I purchased some more. If I'm including closed positions, then the gain on that sale is included in the capital gain figure. And by doing so, it just might obscure what's going on when I'm checking on how my current shares are performing each day. So it's useful to do that, be able to just filter on open positions, but equally, when you're taking a holistic view of your portfolio performance, it's very important, of course, to include not only the unrealized gains on the shares that you own, but the any realized gains on that you've made during the reporting period. And so, yeah, the final thing that I wanted to talk about in this webinar is just to touch on the differences between how we calculate gains from a performance perspective and a tax perspective. As this is often the cause of some confusion. So there are tax and financial reporting standards that require gains, and I guess we're talking specifically about capital gains in this case, to be calculated in a certain way, and often in a way that doesn't provide the most accurate result from a performance measurement perspective. So we can have a little look at where the differences are, and it's important to note that Sharesight's performance reports are designed for performance measurement or performance reporting, and therefore those figures may differ from what we would show in a similar report that's showing sort of the same thing from a tax perspective. So, for example, the capital gains tax report or the traders tax report in New Zealand. So here's just a little example to illustrate that. It's very simple. We have a holding. We've got 2 buy trades. So we originally purchased 2,000 shares at $1. We then purchased another 1,000 shares at $1.50, and then finally we sold down half of the position. So we held 3,000 at this point. We've sold down 1,500 shares. So if we're looking at the gain on the sale, from a tax perspective, we might be required to use a certain sale allocation method. So FIFO, first in, first out, would be the most common method that's sort of mandated for this type of reporting. So if that were the case, we would allocate the sell trade entirely out of the first buy trade. So we would basically figure that we sold 1,500 shares. The difference in price was $1, so our gain is $1,500. Perhaps equally we could be in another jurisdiction where perhaps we can choose a sale allocation method that we can use, or we can do some parcel selection or whatever. So let's, for example, say that we used last in, first out instead. So in this case, we would first of all allocate out of the latest buy. So we'd sell all of the 1,000 shares for a 50-cent gain, and then we'd allocate the remaining 500 shares out of the original buy for a $1 gain, and would work out that our gain now was $1,000, not $1,500 as we did in the FIFO method. And that's fine, and it's good, and that's what we need to do for tax reporting purposes. But I guess if you can imagine yourself and your friend, and you both did exactly the same set of buy trades, it's not really reasonable for one or other of you to kind of claim that you got better investment performance just because of some arbitrary tax rule or some arbitrary sale allocation method that you've opted to use for tax reporting purposes. So what Sharesight does is uses a pro rata allocation method in all cases. So we'd essentially say we've sold down half of our units, so therefore we're going to sell down half of this trade, so we'd allocate 500 shares out of here, and we've sold down half of this trade, so we'd allocate 1,000 shares out of there. and we would arrive at a gain figure of $1,250. And I guess the nice thing about this as well is if we're reporting our performance on the shares we own immediately prior to the sale, and then we look at the performance of the remaining half that we own after the sale, that performance figure is going to remain the same. It doesn't make sense that should the performance on your remaining 50% of the holding should somehow change up or down just because you've sold part of it. Assuming that we're looking at just the gains on the shares that you currently own. So Sharesight is built as a full performance reporting and a tax reporting solution. So we use different methodologies to calculate performance versus tax. So if you're using a compliance or accounting type platform, just be aware that any performance figures are likely calculated using the same rule sets for tax, using the kind of tax rule sets, and that can be misleading. Okay, so just to wrap things up, in summary, in our view, a good portfolio performance reporting solution should, first of all, annualize returns. If you're looking at percentage returns that are not considering the time period, then that information is no use at all in terms of evaluating your portfolio performance. Secondly, it's really important to be able to aggregate data across all brokers. You've got to be looking at a complete picture to be useful. Thirdly, it's really important to include the impact of dividends and including tax credits and currency movements. Fourthly, allowing reporting over custom time periods. Sharesight also has all sorts of other ways to group and filter and get different subtotals, etc. And again, that will be a topic of another webinar. But I guess at a bare minimum, being able to report over custom time periods is really important. And then finally, as we just mentioned, don't rely on taxable gain calculations to derive performance insights, because that can be misleading as well. All right, so that wraps up the presentation. I'm just going to pause for a little minute and have a read of some of the questions that are coming, and I will read those out in just a second. All right, so there's a question here around foreign holdings. If they're converted into local currency for capital gains purposes or dividend purposes, aren't currency gains included or counted twice? And no, they're not. So all of the calculations are basically we're using the source currency to work everything out, and then we're presenting it at local currency right at the end. So obviously, if we're giving, if we're presenting a performance report of your entire portfolio, and we want to provide subtotals and totals, we need to make sure that we're dealing in all the same currency, but that conversion kind of happens at the end. So nothing gets double counted there. The question about what is an X date. That's a really good question. Basically two sort of important dates attached to dividends. So the X date is basically the date that the dividend amount is calculated. So it's the quantity of shares that you hold on the X date that determines the dividend that you will receive. The dividend is typically actually paid out, a week or two after it's kind of technically owing to you. So there's an X date and a paid date for dividends. For tax reporting, at least in Australasia, just for dividends on ordinary shares, it's usually paid date that's actually used for tax reporting. But we use the X date for performance reporting, as I said, just to smooth out any fluctuations in performance that would otherwise occur. The question, do we recommend simple or compound as a more accurate method? I think it's generally most performance calculations use a compound growth rate. But like I said, I think it's important to recognise that this is kind of just an assumption around the way that that investments grow for the purpose of comparing returns over different time periods. So, you can imagine if you have something like a fixed interest investment, it has guaranteed interest payments. It compounds along the way, and that's completely appropriate, most accurate thing to use in that case. I guess we all know share prices are often volatile. They kind of go up and down. They don't follow any smooth straight line or compound kind of growth curve. I guess share markets in the long term do exhibit kind of compound growth, but I think within the shorter term context of a portfolio, there's kind of pluses and minuses to both. I think there are a few gotchas when using a compound return. So if we go back to my slide where we're looking at these gain figures, one thing to keep in mind if you're using a compound return, these numbers don't simply sum across to make a total. And I guess the reason for that is essentially a 5% return, for example, is not twice as much money as a 10% return when you're talking about compounding returns. So you kind of have to just get your head around, I guess, thinking in the compounding context, if you like, to just try and make sure that you're making sense of those figures. Let me just have a look and we'll see what other questions there is. So the question for tax reports, are dividends reported on a payment basis? Yes, they are, generally speaking. So there's some particular rules that we take into account around trust income in Australia, etc., where sometimes it's not the paid date that's used, but that logic is taken care of in tax reporting. There's a question, how can we view portfolio weighting, i.e. what percentage of our portfolio is held in each of our shares? So there's a couple of really good reports you can use for that. One is the diversity report. This basically just breaks down, you can do it by holding or you can do it by groupings to show how your portfolio is diversified against different groups. You can set a date on that, so you can go back to end date and you can kind of see how that changes over time. We also have a report called the Contributions Analysis Report, which is doing something similar, but it's looking at which shares are contributing most heavily to your portfolio gain or loss. So check out both of those reports; they're really useful. So the question about where exactly do you input the customized date? So the performance report in Sharesight is the place to go if you want to set both a start date and an end date for your report. So that's this report here, and you can click in here and you can set both a start date and an end date. You may notice that the overview page in Sharesight just allows you to select a start date. The reason for that really is that that's the page that we expect you to be going to. That's the first page that you land when you log in, and that's the page that you're typically going to keep tabs on your portfolio. And we just want to make sure that that page is always current and always up to date, and it's always showing you the current share price and the picture as it stands today. It's easy to set an end date sometimes and then you forget that you're actually looking at a snapshot back in time. So go to the performance report if you would like to set an end date as well as a start date. The question around time lag between price updates. So for NZX and ASX stocks, we have 20-minute delayed pricing. Essentially those prices are 20-minute delayed. For most of the other markets that we support, we just have end-of-day pricing available at the moment, and we'll look at moving to 20-minute delayed pricing for some of those other markets in the future, and probably we'll start with the US market. Question around benchmarks. So benchmarks is something that I didn't touch on, but you'll see on the overview page or the performance report, it's possible to add a benchmark in here. We've opened that up so you can essentially select any share or ETF or fund in Sharesight's database. We kind of recommend choosing one of the ETFs is a really good thing to use for a benchmark. There's a lot of ETFs. ETF is an exchange traded fund, by the way. So there's a lot of ETFs out there that essentially follow an index of some kind, and that actually provides a really accurate benchmark because it's a thing that you could invest in for real. It does follow the index, and very accurately. But by using an ETF, it means that we actually have all of the distribution data with the tax credits and all of that, and we can we can calculate a really accurate kind of comparison. So yeah, there's a few things that are filtered out from benchmarks, but it tends to just be just some of the derivatives and stuff like that. It doesn't really make sense to benchmark anyway, and we're just a little bit worried that we don't necessarily have complete data sets for some of those things. But aside from that, you can benchmark against really anything in Sharesight's database. Okay, so the question around what performance visualizations does Sharesight offer? So yeah, we do have some different charts that you can select on the overview page. I guess I won't dive into talking about those in this webinar. We'll leave that for a future topic, but certainly have a play around and hop over to our help documentation as well, and we have some good descriptions around how those visualizations work. Okay, so yeah, I think that we actually have a lot of questions here, so I've just kind of been going through and picking a few, but I think we've kind of covered the main ones. If you do have other questions, then let us know or get in touch with our support staff, and we can help you with those.